Okay, so good evening, Sanbonani, Dumelang. Welcome to the second semester, and I'm glad to have you here for our first formal lecture for the semester. So, guys, today we are going to look at the topic short-term financing and planning. This topic refers to the management of the collection of cash from customers and clients, and it also speaks to the payments for liabilities or expenses to our suppliers. So in today's lesson, we are going to discuss how a finance manager manages the cash balances of a business in such a way that it maximizes shareholders' wealth. Remember, that is our objective as a finance manager, that we make sure that every decision that we make is supposed to maximize the wealth of the shareholders. So by the end of this unit, you should be able to explain why it is important for a business to have enough cash to meet its day-to-day operational expenses. And you must be able to also prepare a cash budget. So you are going to be assessed based on the following criteria. You must be able to describe the different components that make up the cash cycle. You must be able to clearly explain the advantages and disadvantages of short-term financing policies. And lastly, and which is quite important, that you must know how to prepare a cash budget correctly. So let's start with the definitions. So can anyone tell me what is liquidity? What do you guys understand by the term liquidity? So in simple terms, liquidity refers to how easily and how quickly a business or a company can convert its assets into cash in order to cover its liabilities. So let's think of it this way. If you have a bread of loaf, it's easy to sell it quickly because people buy bread every day, right? So since the bread can be sold quickly and you receive cash immediately when you sell it, it is considered to have high liquidity. Does that make sense? So in other words, high liquidity means an asset can be turned into cash quickly and easily without much difficulty. Okay, so some assets are not easy to sell. For example, if you own and you want to sell construction equipment, you may have to wait, a long time before you find someone who wants to buy it. So in this case, construction equipment is a less liquid asset. So this means it would take time to sell it, so it cannot be quickly turned into cash, when the business needs money. Does this make sense, guys? Okay, let's move on. So businesses manage their cash for three main reasons. And I'm going to go through all three on the slide there. So the first one is the transaction motive. This refers to a basic need for cash by a business in order for it to pay its everyday expenses, its everyday, operational expenses, such as buying materials, paying salaries, and paying bills like your water and electricity. So the second motive is, or the second one is the safety motive. So a business keeps extra cash available for unexpected emergencies, or such as, repairing broken equipment or covering unforeseen or unplanned costs. And the last one is the speculative motive. So if a business has extra cash, has extra money, it may invest it in shares or other financial instruments so that it can earn more money in the future. Obviously, if there's no other alternatives to use that extra cash, it can, like I said, it can invest it in other financial instruments like your bonds or shares in order to make more money. And obviously, the intention there is to generate more wealth for the owners of the business. So overall, a business must manage its cash carefully to provide good returns for its shareholders, to generate more returns for its shareholders. We are now going to learn about cash budgets, which are an important part of financial planning. So a cash budget is simply put, it's a plan that shows how much cash a business expects to receive and pay out over a certain period, over a defined period. It could be for a 3-month period, a 6-month period, or a 12-month period, or more. So when we prepare a cash budget, we have to follow 3 simple steps. The first one is we must estimate the cash inflows, the cash receipts from our clients and customers. This would include, cash from sales to clients and customers, and it would include cash collections from our debtors. Debtors are people that we would have sold goods to or provide services to on credit. Okay, so whenever we buy or we sell an item to a client who doesn't pay us immediately, obviously the intention is to collect that cash in the future. So obviously the cash collection there in the future from a debtor is part of our cash budget. But I'm going to take you guys through the calculations in terms of how we do the calculations. So I said the first one is we must estimate the cash inflows. Secondly, we must estimate the cash outflows. Guys, can we all please mute our mics? Everyone. Okay, I'm going to go back. So the second step in preparing a cash budget is we must estimate our cash outflows. So this includes payments for our day-to-day operational expenses, for simple things like paying our suppliers, paying salaries, paying rent, and so forth. And thirdly, we must compare the cash inflows, the cash collections that we make against the cash outflows or the cash payments that we make. So this will help us to determine whether the business will have enough cash to meet its obligations in the future. Okay, so obviously in this case, if we collect more cash than we make payments, that would bode well for the business in terms of sustainability and the growth of the business. Is normally or is generally in a healthy financial position when its cash inflows are greater or are more than its cash outflows. So this means the business has enough cash available to pay its expenses and its debts when they are due. Okay. So this one, why prepare a cash budget? This is quite important, guys, but I'm not going to take you through it. This is for self-study. And the fact that I'm not talking to this slide doesn't necessarily mean you should skip it when you prepare for my assessments. Okay. Now, let's talk about this one here. What is a cash surplus? Can anyone tell me in your own words what do we mean by cash surplus? So a cash surplus, in simple terms, is a good sign of a healthy business. Okay, so a cash surplus happens when more cash comes into the business than it goes out during any particular period. So in simple terms, the business receives more money than it spends. So for example, if a business receives 100,000 rands from sales, but it only spends 80,000 rands on its expenses, you know. So it would have a cash surplus of how much? Of 20,000 rands. Cash inflow of 100,000 and cash outflows of 80,000. And obviously the difference there is a cash surplus of 20,000 rands. So like I said previously, a cash surplus simply shows that the business is generating enough cash to cover its expenses. So the extra cash or the additional cash that it has can be used to grow the business. Now, the entity can invest in new opportunities, such as, if it wants to expand into other geographical areas, it can use that cash surplus to do so, you know. So that means once the entity invests or reinvests the cash surplus into the business, it means that there will be increased value created for the business, and that means we're increasing the wealth of the shareholders. Now let's look at cash deficit. What does cash deficit mean? Okay. Now that we have discussed what a cash surplus is, let's now look at the opposite situation, which is called a cash deficit. So a cash deficit happens when a business spends more money than it receives out of the business, out of the business than it is coming in. So if a cash deficit continues for a long time, okay, that can create serious problems for the business, serious financial problems, because the business now might struggle to pay its expenses, to pay its suppliers, to pay its employees, or make payment for any loans that it might have. So if the problem, is not corrected, the business may face financial difficulties and could even struggle to survive in the future. Okay. Therefore, businesses must monitor their cash flows regularly to avoid a cash deficit and to ensure that they always have enough cash to meet their financial obligations. So this slide over here is an illustration of how a cash budget looks like. So this format is unique or different for each business. However, I'm going to use it in my next example. So how do we prepare a cash budget? We start with the opening balance. The opening balance of the cash in the business. So this opening balance will always be given to you. You don't have to calculate it. Then you add receipts. These are your cash inflows. These are receipts from cash sales or collections from customers, including any other income such as dividend income, royalty income, rental income, interest income, or any other type of income that the entity generates. That should go under receipts. Then you minus the payments that were made by the business. So the sum of your opening balance, which would be given to you, and your receipts is equal to your total cash available. Okay. Then subsequent to this, you minus the payments made by the business. So the payments here could be salaries, rent, it could be anything that results in a cash outflow from the business. And that could also include cash payments for buying equipment, equipment such as computers, motor vehicles, and so forth. So your resulting figure, okay, is either a cash surplus or a cash deficit. So what you do is you take your total cash available and you minus your payments, your cash outflows, and the resulting figure here is either a surplus or a deficit, depending obviously on whether the inflows exceed the outflows or vice versa. Are we clear? So now that we have gone through, the theoretical principles of preparing a cash budget, I'm gonna share an Excel template that has a class example that will speak to how we should prepare a cash budget. Guys, let me know if you are able to see the Excel template that I've just shared. Katlego, can you see it?
Yes, I'm able to see it.
Okay, guys, I'm going to give you 1 minute to read through the information in the question. Then we are both going to discuss the solution in terms of how we prepare the cash budget. So the first thing that you guys should do with any question, before you go through the details of the question or the information that is given to you, you should always first read the required. Okay, the required says prepare a cash budget for the 3 months, July, August, and September 2026. Okay, so what's going to happen is in your assessments, I will give you a sort of a skeleton of what you should use to prepare, sort of a template that you should use to prepare a cash budget. So you will be given something similar to this, okay? And there will be workings as well at the bottom. But then you need to populate the cash budget with your workings. Guys, like I said, I'm going to give you 1 minute to go through the information, then we will go through the solution. Okay. So like I said, we first read the required, and it said we should prepare a cash budget for the months July, August, and September. So what you need to be aware of is that cash budgets are always future looking. We're always looking at transactions or events that are going to happen in the future. Hence, we call it a budget. So in most cases, when we prepare a cash budget, we look at transactions that are going to happen in the future. Okay, obviously, like I said, what are those transactions? It's your income and your expenses, and we need to estimate them. But then how do we estimate those numbers? How do we estimate those future income and expenses? We normally look at historical figures. We look at the trend in the past years or months, and that is a good indicator. Not always, though, in terms of what's going to happen in the future. Okay, so the information that is given to us here, it outlines the transactions that we need to budget for. So what are those transactions? It's your sales, that's your income, it's your purchases. So we are going to assume here that this entity sells goods. Okay, it buys items from its suppliers. Okay, so when it buys, those are what we call purchases. Then it sells the same items to its clients and customers. So obviously they would add a markup, on their costs in order to make a profit. Okay, so what are the transactions? It's your sales, it's your purchases, it's your overhead expenses, and your salaries, your wages. Okay, so these expenses and income items are given to us for a period of 4 months from June to September. And what is important to understand is it's the additional information that is given here at the bottom. Okay, so this information actually provides more clarity in how we should account for these transactions in our books. Okay. So the first line item, the first note there says, or additional information says, 30% of all sales. Can you please mute that person? Okay, I'm gonna go back. So let's read we have 5 notes, or 6 notes rather, to look into here before we even start doing anything. So the first one here says 30% of sales are for cash. And data settled accounts 1 month after sales, less 2.5 settlement discount. Okay. Second one says all purchases are on credit. The suppliers are paid 1 month after purchase, less 5% settlement discount. So guys, no, let me do this. Let's take each item as identified here, and let's try to use that information in the question that is given to us. Okay, now the first thing that we're going to start with is the sales. Okay, so my solution is split into 2. I have asked you, or the question has rather asked you to prepare a cash budget, which is this part over here that is not highlighted. This is a cash budget. Okay. And at the bottom here are the workings. Okay, for each item that you're supposed to account for in our cash budget. So let's look at the opening balance. What is the opening balance of our cash budget here? So our budgeting period starts from the 1st of July. And what is the opening balance of our cash on the 1st of July?
It's 11,750.
Yeah, that's correct. So this is a simple copy and paste, 11,750. Okay, now we have to look at the cash receipts, the cash that we collect from our clients and customers. Okay, now let us go back to the information that is given to us. So we have to account for all these sales. Okay, now the first note here says 30% of all sales are for cash. So that means of the 120,000 rands of sales in June, 30% of that we receive cash immediately. Now, what is the balance? The balance is 70%. So that means 70% of these sales are on credit. It's not said here, it's not mentioned here explicitly, but that's what it means. Are we following? So, but then how do we collect those credit sales from our debtors? Okay. I suppose we all know what the word debtor means, Debtor. Debtor means we would have previously sold goods to clients on credit. So when we made the sale, we did not receive the cash immediately. So then instead of receiving cash immediately, we raise a debtor in our books. That means this is somebody who's going to pay us in the future. So that's what the debtor means. So the 70% will be settled after 1 month. So of the 120,000 rands of sales that were made in June, we only collect 30% of that in the current month, in June. Okay, in June. Then the 70% will be collected in July. But then we have to give a 2.5% settlement discount when the debtor pays us. Okay, so I'm going to show you the calculations. How do we do those calculations? So we said in June, how much were the cash sales? 120. How much were the total sales? 120,000. Okay, can you guys remember 120,000? But then only 30% is collected in that month, in the month that the sale is made. Okay, so 36,000 would have been collected in June. Are we clear? And you need to be careful, So the question is specifically asked or requires us to prepare a cash budget from July up until September. Okay, so in June, how much were the credit sales? 84,000. So that means 120,000 rands multiplied by 70% is 84,000. Sorry, this is wrong. Okay, so of the 84,000 here, the credit sales in June. Yes.
One student has his hand up. Malife.
Okay, go ahead
You can
ask.
speak.
Evening, sir. No, I wanted to ask about the 11,750 of the opening balance for July. Where did you find the 11,750 for July?
Note number 6.
I didn't see that. Okay, thank you, sir.
Okay, like I said, 70% of the sales in June, credit sales is 84,000, and this will be collected in July. Now, how do we calculate that collection in July? Okay, so let me just show you how we do the calculation. So remember the note or the additional information that is given to us is that we have to give clients or our debtors a 2.5 settlement discount. So of the 84,000 that is owing to us, we are only going to collect 81,900 rands. So how do we calculate that 81.9? We take, let me show you this. So we take the 84,000, yeah, and we multiply it by 97.5. So 97.5 means we have taken out or taken off the 2.5 settlement discount. And let me show you how I cut that figure. It's 100 minus 2.5. 2.5, that should give you 97.5. Can you guys see this? How we got to the 97.5? This is after the settlement discount of 2.5. Are we following? Okay, so the 81.9 is what we are going to collect in July. These are the credit sales that were made in June. Okay, so remember we said in July, total sales is 180,000. But of that total income, we only collect 30% of it in that month. So let's put those numbers here. Cash sales. Okay, so what are the total cash sales that we're going to collect in July? It's the 180,000 times 30%, which gives you 54,000. Is that making sense? Let me show you the calculations here at the bottom. So these numbers here at the bottom are given to us, the 180, the 165, and the 150. So we don't have to calculate those numbers because they are simply given to us. But then we need to split those total sales between cash and credit sales. So of the July sales, we only collect 30%. And of the August sales, we collect 30, and the same with September. Are we clear? So hence that line item over there shows only 30% of the total sales. Is that making sense, guys? Okay. So if you keep quiet, I would assume that you guys understand, and I'm going to move on. So what about the debtors collections? So the question specifically said to us, credit sales are collected in the following month, 30 days after the sale has been made. Okay. So of the credit sales in June, we collected 97.5% in July. So of the credit sales in July, we only collect 97.5% in September, in August, and the same for the credit sales in August, which will be collected in September. Are these numbers making sense, guys? How did I get the 122,850? It is equals to the credit sales in July after taking out the 2.5% settlement discount, and the final figure that I get, which will be collected in August, is 122,850. The same for the cash collection or the collection from the debtors in September. This speaks to the credit sales that we made in August, the 115500. Only 97.5% of that figure is collected in September. Are we clear? So these are the numbers that we should put into our cash budget. There we go. Now, remember I said cash receipts include income from, normal operating processes of the business, including ancillary income such as your rental income, commission income, interest income, dividend income, including the sale of any items in our business. So if we look at point number 5, it says in September, old furniture costing 25,000 is to be sold for 3,000 rand cash. Can you guys see this one here? In September, we are selling off old items, old furniture, which we had initially bought for 25,000, but we were selling them for 3,000 rand cash. So there's something that I didn't mention over here. Ne? Okay, maybe just before I explain that, ne? How do we deal with the 25,000 here? How do we account for this 25,000? Anyone? So this is a historical cost, okay? So we assume here that this item, this furniture, was bought many years ago. So the cash payment for the acquisition of this furniture happened many years ago. So in the current financial year, we only account for any cash receipts from that asset. So we don't record the 25,000 in our cash budget because it was paid for a long time ago. So the only thing that we need to put in our cash budget is the cash receipt of 3,000 rand, and it's going to happen in September. Okay, so we add up all the cash receipts for each month, and that's what you get there. We collected 135.9 in July, 172 in August, and 160 in September. And cash available is the sum of your opening balance plus your cash receipts. So this number over here is made up of your opening balance plus all the cash receipts in the period. Okay. Now let's go to the payments, the cash outflows. We have 3 types of cash outflows. We have purchases. So these are purchases of inventory items that we eventually sell to our clients. So let's look at the note here that speaks to purchases. So it says all purchases are on credit. So there is no immediate cash payment when we buy these items. However, we have to pay our suppliers 1 month after we have made the purchase. And we get a 5% settlement discount. So these are all the purchases. So the purchase that we made in June will be paid for in July after taking back 5% settlement discount. And the same principle will follow for the next month. Okay, but now let's do those calculations. So these are your creditors' payments. These are your purchases. Okay. Okay. So what were the purchases for June, July, August, and September? Those numbers are given to us. Okay. But we know that payment is made 30 days after acquisition. So again, with the payments, I hope you guys are following my logic here. So we made a credit purchase of materials in June of 90,000, and we only pay 95% of that because we get a settlement discount. So 90,000 times 95% gives you 85.5. And the same with the purchases that we made in July. So these were the purchases. This is what was invoiced to us, all these numbers over here, but we only pay 95%. Okay. Are you guys following the logic here?
Sorry, sir. For some other reason, I can't see what you're projecting now. It just went away.
Yeah, no, if that's the case, this session is recorded. So if you go back to it, once I'm done with the lecture, I will share the link to it. Then you should be able to see what I've shared.
I also can't see your screen, so I think it might not be his problem only. I don't know. Maybe it's on your side. I don't know.
Katleho, can you see?
I
Yeah,
can
can you
see
mute?
it.
Please mute your mic. Katleho, can you see my screen?
Yes, I can see your screen.
Yeah, then guys, it's the problem is on your side, and that
I cannot see.
yeah. Look, guys, you don't have to tell me individually that you cannot see. If one person is able to see my screen, that means the problem is not on my side. And like I said, and I'm repeating that once you get the recording to this link, you should be able to see what I'm sharing here. The problem is not on my side. Okay. Okay, so let's move on. So those who can see, do you guys get how I got to these calculations over here? And those who cannot see, please log off and come back in again. Your problem will be resolved. Okay, somebody said yes, you follow the calculations. So these are the cash payments that we make for the purchases, and we put them in the cash budget. There we go. Payments. Then we have overhead expenses. Okay, we have overhead expenses. Again, they're given to us. Those are the expenses that we incurred for overheads for each month. And let's look at this note over here. It says overhead expenses include depreciation of 5,000 rands per month. So how do we deal with this depreciation? We are told that this 5,000 rands of depreciation is included in the overhead expenses. How do we deal with it in our cash budget? Maybe let me ask another question. Is depreciation a cash item? Does it represent a cash outflow? Depreciation.
So I think it's not a cash item. I think it's not a cash item.
It's not a cash item. Okay, that's correct. It's not a cash item. Okay, because depreciation is just an accounting entry. Okay, so maybe let me explain the concept of depreciation. So when we buy an asset, from a financial accounting point of view, let us say we pay cash for the acquisition of that item. Okay, so that asset that we have bought will be capitalized. It will be put in our balance sheet, okay, as an asset. So as and when we start to use that asset in our business, we write off the value of that asset into the income statement based on the, on the lifespan of that asset. So for example, if we expect that asset to have a lifespan of 5 years, so that means the value of that asset will be written off over a 5-year period. Okay, so the write-off there is not a cash item. It is just an accounting entry because the cash outflow would have happened when we initially bought that asset. For example, in this case over here, the 25,000 of old furniture. Okay, let us say this asset was bought 3 years ago. So the cash outflow of the 25,000 would have been accounted for 3 years ago already. Okay, so depreciation is not a cash item, therefore we have to take it out in our calculations. So in our workings, we are told that overheads, these are the overheads per month, but they include depreciation. Hence, we have to take it out. So every single month, we have to take out any non-cash items. So therefore, our total cash outflows are these numbers over here. And let's go back to the information in the question. It says payments are made 1 month after the expense has been incurred. Okay, so again, it means if an expense is incurred, which is defined as an overhead expense, if it is incurred in 1 month, it will be paid for in cash in the following month. Okay. So these are the payments. The overhead in June will be paid for in July and so forth. And we slot or we put those numbers in our cash budget. Happiness. Can I move on? Okay. What about wages? Wages are paid in the month they are incurred. So we don't have to do any calculations here. This is simple copy and paste. 30,000 in July, 34 in August, and 32,000 in September. And that's what we put in our cash budget. Okay. Copy and paste. Now the last one is we are planning to buy a new computer in August for 28,000. And that's what we put in our cash budget. New computer in August. So all of these are cash outflows. So we add them up. This is the sum of all our cash outflows for each month. So how do we calculate the closing balance for each month? Can anyone please calculate the closing balance as at the end of July 2026? Okay.
4,150.
Say again. Please repeat.
We say 147,650 minus the less payment of 143,500, which totals to 4,150.
Yeah, that's correct. So our closing balance as at July is 4,150. So what has happened here? Our opening balance is 11,000, but we have a closing balance of 4,150. So that means the cash receipts, are lower than the cash payments. Hence, there's a huge decrease in our cash flows in the month of July. So what is the opening balance for August? What is our opening balance for August?
4,150.
Exactly. So the closing balance in the previous period becomes the opening balance in the current period. Okay. Now we do the same calculations. Opening balance plus your cash receipts gives you 176,500. Okay. And that gives you the cash available in August. Then from that, we minus the cash payments in the same month. And our closing balance is 31,500 rand. So there's a huge jump from the opening balance to our closing balance. Okay. Simply because, why has that happened? It's because our cash receipts have gone up quite remarkably. We made more sales. Did we make more sales in August or not? Yes, no? Guys, come talk to me. So the huge jump was because of the sales that we made in July. See now, there's a huge jump in terms of. Say again?
No, we didn't make
Please
any
repeat.
sales.
We did not make any sales.
Yes, sir.
So I just want to make sure that I hear you correctly. Are you saying we did not make any sales in August?
Yeah, we didn't, sir.
So please explain to me, what is that number for? What does it represent, this number?
It's, oh, no, the 49,550, it's cash sales. Oh, sorry.
Exactly. So there were sales made every single month. The reason why our total cash collections have gone up so much, it's because of the credit sales or the cash collections from the credit sales that we made in July. They've gone up quite considerably, from 82 to 123. Can you see that? Even though cash sales have dipped a bit, they've gone down a bit. And payments are almost similar, almost the same. Okay. And our payments could have been less, if it was not for the acquisition of the new computer. Let me take out the cost of the new computer. We would have made payments of 117,000 had it not been of the acquisition of the computer. But anyway, overall, our cash budget, sorry, our cash account has gone up quite a lot. Okay, so like we said, the opening balance or the closing balance in 1 month is equals to the opening balance in the following month. So the opening balance in September is 31.5. Okay. So our cash available, again, cash collections in September as compared to August, they've gone down by 12,000. Okay. So our cash sales have gone down compared to August, and also our cash collections from our debtors have also gone down. Okay. Even though there was a slight increase in our income because of the asset that we sold. But again, in terms of our payments, our purchases have gone up quite a lot. I mean, this amount is double what we paid in August. So chances are we have more inventory sitting in our balance sheet that we are going to sell in the future. So the benefit of it is that we will see more sales in October. Is that making sense? So we are hoping that if we sell all these items that we bought in August, so in September rather, there will be increased sales in October, and therefore the closing balance in October will marginally go up as well. So guys, any questions? Any issues? Katlego, do we have hands up in the chat? Or do we have comments in the chat?
No, there's no question.
Okay. Guys, if there are no questions, I'm going to stop my lecture now. Let me just stop this. Guys, thanks for